Hey everyone, welcome back to the Dental Wolf YouTube channel. In this video, we're going to dive briefly into our first part of financial statements. Alright, so as an intro to financial statements, these are basically the three amigos of financial statements.
The three amigos!
You have your income statement, your balance sheet, and your cash flow statement. So the one that's most important when you're analyzing a practice is going to be your income statement. So that's the one that we're going to dive into first. All right, income statement. So the income statement is also known as a profit and loss statement. So as you can assume, it's going to describe your profits and your losses or your expenses. Now this income statement has a lot of numbers, so I want you to ignore all the numbers right now and don't get overwhelmed.
Do you want my head to explode?
So the first thing that you can see on a profit and loss statement is gross receipts. So in dentistry, we like to refer to gross receipts as collection. Or in other words, after you've produced X amount of money, how much are you collecting from that adjusted production? So that's our profit piece of the profit and loss statement. The next piece of it are our expenses. Now we have two types of expenses here. We have direct expenses and fixed expenses. So direct expenses you can think of as kind of the cost of goods sold, or in other words, the expense of the actual service being provided. So that's going to include everything between lab fees to office supplies, your anesthetic, basically everything that went into making the service possible from a material standpoint. So if you think about it this way, let's say you have a hot dog stand and you're selling hot dogs. Well, the direct expense of a hot dog is going to be the cost of the bun and the dog and any, toppings or whatever that you put on it. On the other hand, fixed expenses are things that don't change. Regardless of the amount of dentistry that you produce, these expenses will always be there. So that's things like rent, utilities, staff salaries. If you're paying your staff on an hourly wage, you could argue that those are direct expenses, but if they're salaried, or in other words, they get a guaranteed pay, I would put those as a fixed expense. So as you can see, a dental practice has a lot of fixed expenses, things that won't change, and their direct expenses are minimal. So this is what's going to supply the field of dentistry with what we call an economy of scale. So economy of scale is just a really fancy way of saying that the more you produce, the smaller your expenses are as a percentage. So then we have gross profit. So gross profit you can think of as just basically the revenue generated from the sale minus the direct expense. So it's like after I have my hot dog and I've sold it, how much did I actually make after I've paid for the hot dog, the bun, and all the toppings? And then you have operating income. Operating income is a similar idea. It's just the income after the operating expense. And operating expenses include the direct and fixed expenses. Now, there's something unique about dentistry, and that's that one of the main employees of the practice usually is also the owner of the practice. So you, as a doctor owner, get paid in kind of two different ways. You get paid as a doctor, and you also get paid as an owner. So this next piece, what you're going to do is you're going to subtract out what you would have paid yourself as a doctor, and that's going to leave you with what we call EBITDA. So EBITDA is just a really fancy way of saying earnings before interest, taxes, depreciation, and amortization. A lot of fancy words there, and we can go in and dive into what those actually mean later. But what you need to know about EBITDA is this number, EBITDA, is going to be how you primarily value practices. This is stating, after all is said and done, how much are you making as an owner? And EBITDA is calculated before interest, taxes, depreciation, and amortization in order to be able to compare two practices on equal playing field. So let me give you an example. Earnings before interest expense. So interest expense is going to happen when a practice is bought using debt, which almost 100% of them will be, right? Unless you're buying a really tiny practice and somehow you've saved up a ton of money. Almost everyone's going to buy their practice using some amount of debt. Well, that interest expense is going to vary between different practices and different practice owners. And so EBITDA kind of levels the playing field between different practices because it ignores that interest expense. It just looks at how much of the business is actually producing regardless of all these different other factors, right? So EBITDA, we'll dive into this in valuations. EBITDA is going to be the most useful number in valuating a practice. So I hope that was helpful. I know that was a lot of numbers, a lot of words. Feel free to rewatch this video, dive into the words a little bit more and to understand a little bit more of the vocabulary. If you like this, give us a thumbs up, subscribe. We're going to be posting a lot more videos. And please comment on anything that you would like to learn more about. There's a lot of topics in dentistry, a lot of complicated concepts, especially for a lot of us who didn't have business as a background in our undergrad. And feel free to email us at dentalwolfonline@gmail.com. And I hope you guys have a good one, and stay tuned for the next video. Thanks.